Okay, let's talk about financial planning. We all do it, right? We plan for retirement, for that dream house, for our kids' future, but there's this one giant unavoidable problem. The future is a total mystery. So how in the world are you supposed to plan for something you can't possibly predict? Well, that's exactly what we're going to get into today. I want to kick things off with a pretty provocative question. Think about the way most of us map out our financial future. You know, the way those online calculators work. It's almost always built on one single core assumption. And as we're about to find out, that one little assumption, it might just be the weakest link in your entire plan.
So where does it all go wrong? It boils down to a concept that sounds really simple but has some seriously huge consequences. It's something called the flaw of averages. The big idea here is that planning for an average outcome is basically a setup for failure because, let's be honest, when is life ever truly average?
We all learned about the arithmetic mean back in school, right? You just add up all the numbers and divide. Simple. But here's the catch. Its biggest weakness. It's super sensitive to outliers. A couple of really fantastic years or a couple of truly awful ones can yank that average way up or way down, leaving you with a number that doesn't really tell you what a typical year even looks like. So let's see how this plays out. This is a super common way to project a retirement portfolio. You start with, say, 100 grand. You plug in an 8% average annual return, which is a pretty standard historical number to use, and voila, 30 years later, you're a millionaire. It looks amazing, doesn't it? It's this smooth, straight line to success. The path looks totally clear. But, and this is a huge but, the market has never, not once, delivered a steady 8% return year after year after year. That's not how it works. The real world is messy, it's up, it's down, it's volatile, and that volatility completely rewrites the story. Now let's look at something a bit more realistic. So, year one, you're flying high, up 25%. Awesome. But then, year two, the market tanks and you're down 15%. Now, even though the simple average of those two returns is still a positive number, the order in which they happened makes a massive difference to your bottom line. This is something called sequence of returns risk, and it's the critical danger that the whole flaw of averages thing just completely glosses over. Okay, so if we can't trust that one single average number, what do? We can't predict the future, that's for sure, but we can get a whole lot smarter about preparing for it by exploring all the different ways it could unfold. And this is where financial simulations become our superpower. This right here is the game-changing idea. Instead of betting our entire retirement on that one single straight-line projection, what if we could map out thousands, even tens of thousands of different potential futures? Each one a unique roller coaster of good years and bad years, just like in real life. And that's exactly what a simulation does. It's like a powerful what-if machine. It uses computers to generate this entire universe of possibilities. Now, it's not a crystal ball. It won't tell you what will happen, but it gives you this incredibly rich picture of what could happen, from the absolute best-case scenarios all the way down to the worst. It lets you see the whole landscape of risk. All right, so how do we actually do this? One of the most famous and powerful ways is called a Monte Carlo simulation. The easiest way to think about it is this. It's like simulating the future, but with a rulebook. So here's the crucial part. Monte Carlo isn't just pulling random numbers out of a hat. It all starts with a model, a set of mathematical rules that describes how we think something, like the stock market, behaves. We define the rules of the game first, and then we let the computer play it out thousands and thousands of times. And having the right rules is so important. For instance, you can't just use a simple bell curve to model stock prices. Why not? Well, a bell curve would suggest a stock could have a negative price, which is just impossible. So instead, financial pros often use something called a log normal distribution. It's got two key features that make it way more realistic. First, it can't go below zero. And second, it has a long right tail, which accounts for those rare but massive upswings in the market. It's just a much better fit. So when you break it down, the process is pretty straightforward. Step one, you pick your model, your rulebook. Step two, you unleash the computer to generate thousands of unique 30-year retirement journeys based on those rules. And step three, you just stand back and look at the whole collection of results to see what the full range of outcomes really looks like. But what if you're not totally comfortable creating a theoretical model about the future? What if you're the kind of person who thinks the best guide to the future is the past itself? Well, that's the whole philosophy behind another cool technique called bootstrapping. Bootstrapping takes a completely different road. Instead of starting with a fancy math formula, it starts with the real deal, actual historical data. Maybe the last 50 years of monthly stock returns. And that little phrase there with replacement is the absolute key to how it works. This is the core idea of bootstrapping in a nutshell. It's just super pragmatic. It basically says, look, I don't pretend to know the secret mathematical formula for the future, but what I do have is a fantastic library of what's already happened. So let's use that. Okay, so here's how it works. Picture a giant bucket filled with 360 little slips of paper. Each slip has one monthly return from the past 30 years written on it. To build one possible future, you reach in, you pull out a slip, you write down that return, and here's the magic part, you put the slip back in the bucket. You do this 360 times to create one 30-year path. Putting it back each time means that any month from history could get picked over and over, which keeps the original stats of the data intact. Then you just do that whole thing thousands of times over. So let's put these two side by side. What's the real difference? Monte Carlo is all about building a model. It's forward-looking. It's awesome if you have a really strong reason to believe your model is a good description of reality. Bootstrapping, on the other hand, is all about the data. It's backward-looking. It's a fantastic choice when you think the past is a pretty good guide for the future, but you don't want to force it into a specific mathematical box. Now let's bring this all the way back to our original retirement problem. We started with this simple, clean forecast that, as we saw, was pretty misleading. So what does our plan look like after we've run it through a simulation? Remember this number? Our $1.06 million? It felt so certain, so concrete, but it was built on a really shaky foundation. It told us what would happen, but it gave us absolutely zero information about the risk we were taking to get there. And this is the incredible payoff. After you run thousands of simulations, you don't get one number back. You get a probability. The results might show that in 82% of all those possible futures, you hit your goal. Awesome. But it also shows that in 18% of them, you fell short. And now you have something you can actually use to make a decision. Maybe an 18% chance of failure is way too high for you. That information might lead you to save more or tweak your investments. This really is the heart of it all. It's about a fundamental shift in thinking. You move away from the false promise of a single prediction, and you move toward the practical wisdom of understanding probabilities. And that lets you manage your risk in a way that's just impossible when you're staring at a single average. So, to wrap it all up, depending on simple averages is dangerous because it completely ignores the real impact of volatility. Simulations, whether you use a model-based approach like Monte Carlo or a history-based one like bootstrapping, let us see thousands of possible futures. And the goal isn't to get some magic prediction. It's to get a clear, confident understanding of our chances of success so we can make smarter, better-informed choices. At the end of the day, we can never get rid of uncertainty. It's always going to be part of our financial lives. But we can absolutely change how we deal with it. Instead of clinging to a single, fragile average, we can embrace that uncertainty and actually plan for a huge range of possibilities. The tools are there. The only real question left is, are your decisions ready for it?